There is no simpler strategy as reliable as the ICT silver bullet. ICT himself said that you can literally quit your job in under 90 days just from implementing this strategy in your day-to-day trading. With a solid win rate and no daily bias, you can pick up this strategy in no time. In this video, I'm going to be giving you a simple yet effective approach to the silver bullet strategy in order to maximize your profits and see consistency in your trading journey. So, first things first, what exactly is the silver bullet trading strategy? The ICT silver bullet strategy is a time-based trading model that works best with specific forex pairs and focuses on high probability trade setups. The strategy works best with fair value gaps, liquidity sweeps, and market structure shifts. What pairs does it form on the most and what specific times? The highest probability pairs from my own backtesting are the S&P 500, NAS 100, Euro USD, and GBP USD. The timings that we'd want to mark out on our charts are the following. New York session 3 p.m. to 4 p.m. UK time, 10 a.m. to 11 a.m. New York time. And for London session, we'd want to have marked out 8 a.m. to 9 a.m. UK time and 3 a.m. to 4 a.m. New York time. To implement this strategy without any silly mistakes, the best thing to do is to start backtesting on previous price action. There's no point learning it then jumping right into the live markets and taking entries without testing what pairs and timeframes work best according to your personal trade plan. Luckily for you guys, I've created a very simple to understand trade plan with a few diagrams to help really sink it into your brains so that your chart work and backtesting becomes much more easier. It may also come in handy to note this trading plan down in order to replicate it without any confusion. Step 1. Identify the liquidity prior to London and New York Open. So this is completely up to you whether you do this on Euro USD, NAS 100 or any forex pair out of the high probability pairs for this strategy. You'd want to mark out the open and the close to get a clear picture of the price action you're working with within your chosen time zone. The best way to go about this is to get an indicator on TradingView and to modify it to the London and New York ICT trading times that are in the previous slide. So back to our main point. Before the time zone, whether it's London Open or New York Open, you'd want to mark out any forms of liquidity that could potentially get swept. The best time frame to implement this analysis on is the 1 minute time frame to ensure that we catch the exact moment when the liquidity gets taken out before anticipating a market structure shift. Now, before I get into step number 2, here are some common examples of liquidity if you're unsure what to look out for. We have the equal highs and equal lows, or double tops and double bottoms. We have trend line liquidity, which is usually following a minor bullish or bearish structure. And we have ranging liquidity, which is a similar concept to trendline liquidity, except that it's more like sideways action rather than bearish or bullish. This is commonly known as consolidation, which is when price respects support and resistance like movement, essentially flowing between a channel, as you can see in the example on the right. If you're unfamiliar or think you'll forget any of these examples, be sure to take a second, pause this video and note down or screenshot to remember in the future. These are examples that will come across in the charts later on in this video. Now, before I continue with the presentation, I may have something that will interest you. If you want to get funded 6 figures in trading capital completely guaranteed in under 24 hours, make sure to click the first link in the description, which will lead you to my Telegram channel where me and my team will assist you in the swift funding process. If you didn't know, the failure rate for passing a prop firm challenge is over 90%. Instead of wasting money and failing multiple challenges in a row, we can pass your challenge, get you funded 6 figures the same day, and to top it off, you only pay after we pass it for you, so there's no risk from your end. Be sure to take this opportunity and drop me a message through Telegram before the slots get taken up. This is a limited time offer that you don't want to miss. And for those of you who want to take this opportunity to a whole other level, I have developed a unique trading algorithm that isn't only tailored to pass your prop firm challenges, but also goes on to generate you anywhere from 4 to 12% a month. Now I know that's a bold claim to make, but with many of my clients passing challenges and consistently receiving payouts, I can only imagine what a great opportunity this is for you. If you're interested in joining, message the word ready to the second link in the description below. Now let's continue with the video. Step 2. Anticipating the market structure shift. Once we see a liquidity sweep, we'll wait for a market structure shift, or as some refer it to as a change of character. In basic terms, a change of character happens when price goes from bullish to bearish or bearish to bullish, hence why we call it a market structure shift. The market structure shift will be our prime confluence to enter once price retraces down towards the displacement or fair value gap before continuing up to our take profit in the example on the left. Step 3. How can we identify a valid market structure shift? It's simple. As soon as liquidity is taken out and price reverses, a fair value gap or imbalance is usually left behind. A fair value gap is a sudden move which is caused by heavy buyer or seller momentum. Essentially, it involves three candles, where the first and third candles don't make contact, hence the word gap in fair value gap. This is where ICT and smart money have a direct correlation. In smart money concept terms, this particular entry model is known as a change of character entry. Essentially, we're entering off of a shift in the market structure where price may have been bearish at first until our last lower high was broken. That's where we come in and enter buys based off of the structure shifting from bearish to bullish. Step 4. Entry setup. You want to set your stop loss in line with the most recent low or just below to be on the safe side. Your order block should be drawn out in line with the second or middle candle where the displacement has happened. Your take profit could be the most recent high or the opposing liquidity above. Choosing the take profit is all down to your analysis and what areas of liquidity you've marked out. I personally take profits when I see at least a 2R setup, otherwise anything below that is essentially a 50% probability. Here's the difference between a 1-to-1 RR setup on the left and a 3-to-1 RR setup on the right. The 3-to-1 setup gives you a 75% win probability and 25% losing probability, as opposed to the 1R setup, which only gives you a 50% win and 50% loss probability, which is less profitable in the bigger scheme of things. So the best thing to do in my personal opinion is to bank in at least 2 Rs from a setup to ensure you have more breathing room with your entry and stop loss, and to maximize on potential profits that you could miss out on with a low risk to reward setup. Now let's move on to the chart so I can show you guys how to set the strategy up as if you are trading it live. So as you guys can see, I have the NAS 100 chart loaded up on the 1 minute time frame. Now before I get into this example, this is the indicator that you guys should get. It's called the ICT kill zone. These are the timings that I've put in. These are the same time zones that I've put in the previous slides. So if you didn't know, these are the time zones right here, the London Open and the New York Open. You'd want to ignore these because these aren't really important. It's these two that you'd want to mark out. Now, as you can see in the example here, price is initially bearish. We've printed lower highs, lower lows, lower high, lower low. Now, before the London or New York Open, let's just say this is market open right here. Price was initially bearish, as we just said. We'd mark out our liquidity. So we've marked out liquidity over here and over here. Now, what we'd want to do here is wait for either the buy side or the sell side liquidity to get taken out before we can choose what move to make next. Now, in this specific example, you can see sell side liquidity was taken out. And after the sell side liquidity was taken out, a fair value gap was formed. You'd see this much better in the example that I'm about to show you next with the candles. But let's just assume this is a fair value gap right here. So an impulsive move was made to the upside, causing a market structure shift. We've broken this structure right here. So we've broken this lower high right here. As price retraces back, we failed to break this low as well. This indicates that the market is going to continue to the upside, which is perfect for our ICT silver bullet strategy. From the fair value gap that we've marked out earlier, as price retraced down, we'd want to enter off of the 50% mark, as we can see right here. So we'd place our entry right about here. We could put our stop loss just below the fair value gap, like so, or we can put it just below the most recent low. This specific setup usually gets us anywhere from 2 to 3 to 4 risk to reward. So now let me show you guys how this would look on an actual example. So as you guys can see, this is the live candle chart on the NAS 100 on the 1 minute time frame. Now, first thing we'd want to do is mark out our liquidity. We have an area of liquidity up here. We have an area of liquidity down here. And we could also say that the other low as well over here is an area of liquidity, which did get taken out. So if we play price out 1 or 2 candles later, we can see the sell side liquidity has just been taken out. So if we'd mark this out like so, this got taken out and this one also got taken out just before the market opened for the ICT kill zone. Now, because the sell side liquidity did get taken out, now we'd want to start looking for buys after a market structure shift. So the second thing we'd look for is a market structure shift, which was also made with a fair value gap. So we can see right here, we have created a fair value gap where these two candles do not connect. So if we get our fib tool and draw out a order block right here, we draw it out from the tip of the first candle to the tip of the third candle. So the area that the two candles did not make contact. Now, if we play price out even more, we can see we've just taken out the opposing liquidity. Now, this point right here is also part of the market structure, which was bearish. So this could count as a lower high. We've just broken that. So market was bearish. We've broken the bearish structure right here. So this right here can also be marked out as a market structure shift. So if we grab our straight line tool right here, we can mark this out as a market structure shift. Now, in this situation, we'd wait for price to reverse, tap into our order block, and go back up to our take profit. So we'd play price out. We can see price clearly broke the structure right here. So this is a valid market structure shift. Now we'd place a long position. We'd place our entry on the 50% of the fib tool, and we can either place our stops just below the imbalance or at this low right here. That's completely up to you. And the highs, we can either target this high right here. So if we just play price out even more, just to get a better idea of what we're working with, you can see price has tapped in to our order block. Now, I would personally target either this high right here or this high right here. This is completely up to you. So if we just extend this over a little bit, I would target something up here. So if we play price out a little bit more, we can see we've just hit take profit. So this particular setup would give us a risk to reward of 1 to 4, which is roughly what we'd see from this silver bullet strategy. So just to summarize, price was initially bearish. We draw out our liquidity just before our ICT open time. So whether that's the New York Open or the London Open, we draw out our buy side liquidity and our sell side liquidity. If price takes out the sell side liquidity, we'd look for a market structure shift and then a reversal, which would take us to the upside. Same thing goes with the buy side liquidity. If price was to take out the buy side first, we'd anticipate for a market structure shift, a fair value gap, a reversal, and then price to go to the downside instead of the upside in this example. Once again, guys, if you want to get funded within 24 hours, completely guaranteed, click the first link below. If you want to step it up a level and automate your whole funding and payout process, be sure to click the second link below and message ready to get on board on my program. Slots are limited for both programs, so be sure to take the opportunity while it's there. If you enjoyed this video, be sure to like, comment, and subscribe for more value.